under this law. As an example of what's not, clearly not a specified service business, manufacturing, distribution, retail, entities that have hard assets, investments in assets to drive income. If you have a business where the primary income producing aspects of that business is services, this is an area that you need to be mindful of as to whether or not it can qualify.
Yeah, what about you have a sales rep? Where does he fall in it? You know,
So it's an interesting question. It really depends on where he sits in the grand scheme of things. So if the sales rep is an independent contractor, that independent contractor can perhaps create an LLC. But in the end, if it's considered services, sales and services, it may not qualify. We don't know enough about the rules, and we're waiting for clarification in this and a whole host of things.
Even in a disqualified business, if the income levels are below a certain amount, you can still avail yourself to the deduction, right?
Bill was on
Very good, thank you.
it. Lead in.
So there are exclusions from these limitations for specified service businesses and for W-2 wages. And you can avoid these limitations if you're at or below the income threshold test, as this gentleman pointed out. So the income threshold test is $315,000 for a married filing joint and $157,000 of taxable income if you're filing single. It's important to know this is taxable income. On page 2 of the return, all your wages, your dividend income, your interest, K1 income, all your deductions, including itemized deductions. The amount that's taxable, that's basically the test. And if you have income levels over those amounts, there's a phase-in where these limitations start to come into play. We've included an illustrative example to try to tie all these rules together as a way of making some better sense of them. So there's 3 illustrations I'd like to take you through quickly. The first example involves a taxpayer that has wages of $100,000, has deductions of $300,000, and has qualified business income of $500,000, and net overall taxable income of $300,000. And embedded in the qualified business income of $500,000 is a tax deduction for wages of $100,000, and also a tax deduction paid to independent contractors for $100,000. Let's calculate what the qualified business income deduction is under this example. So we first go to 20% of qualified business income, $500,000 times 20% to get to $100,000. 50% of wages is $50,000. And the lower of 20% of taxable income is $60,000. Well, in this example, we don't need to worry about the wage limitation because we're under the $315,000 married filing joint threshold. So the deduction in this example is $60,000. What if the income from this pass-through entity was from guaranteed payment or from royalties? It would not be considered qualified business income. The next example, we raise qualified business income to $1 million. We forget about the deductions for purposes of this illustration. And we have taxable income of $1.1 million. And embedded in the $1 million worth of qualified business income is $200,000 of wages, $200,000 of deduction for independent contractors. Let's calculate the qualified business income deduction. We first take 20% of qualified business income, and we come to $200,000. Then we take the wage limitation of 50%, we get to $100,000. And then we take the lower of 20% of taxable income, which is $200,000. Now the wage limitation comes into play because taxable income is over the threshold, and our 20% deduction, pass-through deduction, in this example is $100,000. And lastly, example 3 is very similar to example 2, only we make the following change. We take all of our expense that's in independent contractors, we make those individuals W-2s. W-2 employees, what's the impact on our deduction? Well, again, we go through the process of 20% of qualified business income, we come to $200,000. Now, because we've moved independent contractor compensation into W-2, our limitation has been increased. So now we have the wage limitation $200,000, and 20% of taxable income is $220,000. So really, the point of this illustration from 2 to 3 is to the extent you make changes in your business, not only in this area, but in lots of other areas, and especially in this law, a lot of planning, a lot of modeling is going to be important to really capture the benefits or avoid the detriments that are a part of this new bill. So some special considerations, some of which I touched on already. Converting independent contractors to employees, it really involves an evaluation of risks and rewards as to make a good business decision. And to the extent that, in the gentleman's point before about taking sales reps for a manufacturer or distributor and moving them from independent contractors to employees can benefit. Specified service business, which we talked a little bit about. Section 199A reduces taxable income, not for any other purpose like deductions in AGI for certain deductions. Section 199A does not modify employment tax rules, and there's no distinction between passive and active businesses. With respect
One other thing I just want to point out on that first item, employee versus independent contractor. If you had an independent contractor who was below those income thresholds, that independent contractor is getting this 20% deduction. So now, if you make that independent contractor who's getting a 20% deduction an employee to help the business owner, they're not going to do it. So, just be careful. You got to look at the independent contractor / employee side as well. Yes, sir.
Quick question, I think you mentioned a little bit before in your example. If you have a company, a lot of time with franchise owners, and local franchise owners, they'll have a company, an employment company, that they use to pay all the employees rather than the employee in each separate company. How is that treated for the, with the wage limitations? That company, is going to be treated as being part of the employee group, or are there rules on that yet?
So it's an excellent question. There's no rules out, but the guidance that most folks are looking to is the guidance in Section 199, which really served as a pattern for Section 199A. So in the context of C corporations, there's a concept of the common paymaster, where you can allocate wages, and those subsidiaries are considered common law, and those subsidiaries, the employees of the common paymaster, those subsidiaries are considered a common law employer for those wages. But common paymasters only work in the C corp context. They do not work in related party LLCs. So if you have a business, as I mentioned earlier, with real estate, or your business where you have LLCs, the common paymaster isn't going to work. So in that case, what we've been doing, and I think it's very widely accepted, is we're looking to the PEOs, the professional employer organizations, where you create, in essence, a common paymaster within the LLC context, where you move the payroll from the management company, the administrative company, up to this PEO, and both the administrative company and the other affiliated LLCs become part of a common paymaster for the LLCs. And there's a regulation or a reference in 199 that basically allows this, and so that's what most people do there. The other thing that we're hopeful for is that when the net investment income tax rules came out, and we were aggregating activities to achieve a certain result, there's hope that perhaps the aggregation rules will somehow apply, but I think we're pretty far off from knowing whether or not that's actually going to happen.
On the employee versus third-party contractor, when you look at that, there's like a checklist that you're supposed to do to make sure that your contractors aren't really employees, right? So
That's
your,
right.
your business decision as your first point is a good idea, because I think once you convert your contractors to employees for this tax purpose, the question comes up, were they employees all along?
That's right. It really,
Which is not.
it really involves, you know, a lot of considerations as to how to maximize.
You shouldn't willy-nilly plan the tax.
You're absolutely right.
Yep. So going back to what I said, the sales rep thing, to consider statutory employees, which is more, you know, onerous than on the person,
That's right.
even though they're really independent contractors.
Absolutely. So we're supposed to run only for another 15 minutes, so, you know, really, in order to let the other speakers present, I'm going to rifle through some of these changes. Depreciation, hopefully it's very well known in the marketplace, and now we have bonus depreciation on assets that are 20 years, have useful life of 20 years or less. You know, the prior law, current law, in terms of depreciable lives, really hasn't really changed all that much. Residential, non-residential real estate, 27.5 years, 39 years, really is basically the same. But the bonus depreciation for qualifying assets placed in service after September 27, 2017, and before January 1, 2023. So this is not a permanent provision, this is a temporary provision. And surprisingly, this new rule starts in 2017, so maybe there's still some planning to do on tax return preparation during 2018. If you use the alternative depreciation system, which we'll talk about briefly, you can't take bonus depreciation. Next slide. Section 179, the taxable years beginning after 2017, the 179 deduction was increased from $510,000 to $1 million. Why would someone take a Section 179 deduction when you can take bonus depreciation? Well, there's a lot of different nuances, but the two that come to mind is, number one, Section 179 is permanent. And number two, when you take a look at state and local tax returns, more often than not, states don't allow bonus depreciation. Most states accept the Section 179 deduction in terms of arriving at state tax level.
And before 2018, there was also another third item. Used property, bonus depreciation only went towards property first placed in service. This new rule, this is the first time they're actually allowing you to take bonus depreciation on used property.
That's right. So let's talk a little bit about some of the less than positive aspects, which are deductibility of interest expense. And like many other provisions that are temporary, this is permanent provision in terms of how we treat interest expense. So business interest expense is now limited to 30% of adjusted taxable income. New terms for adjusted taxable income is laid out in front of us. From 2018 to 2021, it basically is equal to earnings before interest, taxes, depreciation, amortization, so much larger number. And then after 2021, adjusted taxable income is equal to earnings before interest and taxes. To the extent that there's a disallowance in any one year, there's unlimited carry forward. There are certain exceptions for utility companies, for real estate, for companies that have floor planning like automobile dealers, again, a very active lobby group in this process. And also if you have businesses that have average annual gross receipts of less than $25 million a year, these rules do not apply. There's lots of unanswered questions. There's opportunities perhaps that will present themselves to use equity versus debt financing to the extent you run into any of these issues. But one thing that I'd like to impart from all the things that we're talking about is that planning and modeling is really a must when you take a look at all the interrelated provisions in this act in order to get the most bang for the buck and to avoid limitations like the investment interest expense limitation. Next slide. The provisions with respect to interest expense in real estate. In real estate, it's really all about leverage. A lot of the businesses are 60%, 70% loan to value, so you're going to run into this 30% limitation. And so in order to avoid that, there's an election you can make to avoid having the interest expense limitation rules applied to your real estate activity. This election is irrevocable. It changes the depreciation lives from 27.5 years to 39 years to the altered depreciation system to 30 and to 40 years. And there are a number of different things that you need to take into consideration in making this election. And in the interest of saving time, we can talk about that more after the program, to the extent anyone has any questions in that regard.
Okay, maybe what we'll do now is turn it over to Jen and to the international, if you wouldn't mind. So we'll have Jen Sclo-Romano, who's a tax director, will go through some of the international tax provisions.
Okay, good morning, everybody. So just as I raced here from Connecticut this morning, I will be racing through international tax right now. So I'm just gonna, I have a lot of slides here, and so again, we can speak after the presentation. I'm really gonna focus on the two main provisions, the ones that, well, one I call the good news, one I call the bad news. Starting with the good news is this modified territorial tax system that we now have, which is very similar to what we have in the EU. It's a participation exemption system that we finally have, as Don had been talking about, the DRD from a domestic context, sort of being given a haircut. Very opposite has happened in the international context. So a foreign corporation that declared a dividend to a U.S. corporation, there was never a DRD. There was never a benefit in the U.S. for that dividend, and that has completely changed. So now we have 100% DRD if you are a domestic C corporation and you own what we call a controlled foreign corporation, which is essentially a foreign corporation that's at least 10% owned by the C corporation. You now get 100% dividend received deduction for that dividend that comes up. So there are foreign tax credits, obviously, that are disallowed. We have something called a deemed paid foreign tax credit in our foreign tax credit system, which essentially means that if you own a foreign corporation and you are a C corporation and that foreign corporation pays taxes in the foreign jurisdiction, you will get a benefit of those taxes on your tax return as a C corporation. So of course, that benefit will no longer be available here because the income isn't being taxed under the DRD, so you'll no longer get that, that foreign tax credit. We have anti-deferral regimes that are in effect. If any of you deal in the international context, hopefully you do, because or else this is all going to sound very foreign to you. So I didn't know how else to phrase that. So we have certain anti-deferral regimes in the foreign context. One is called Subpart F, one is called investment in U.S. property. So in essence, even if there's no repatriation of cash from a foreign entity to a U.S. entity, there are certain types of income that are still taxed. This regime is still in place, so you know, we have to be very careful about still, even though an actual cash distribution may not be subject to tax, other sorts of income that is not repatriated that's generated with a foreign entity may actually still be subject to tax in the U.S. Also important to note, I have to emphasize again, this is only for C corporations. The individuals, pass-through shareholders of foreign corporations, still subject to worldwide tax. So this is only a benefit for C corporations. I quickly want to throw in there, just sort of from a planning perspective, as Andy had mentioned, there's a lot of planning around all of this tax law. With respect to this territorial regime, one of the things that we've been talking about at our firm is the ability to convert ordinary dividends now to qualified dividends using this modified territorial regime. So a very quick example. You have an individual that owns 100% of a corporation in a non-treaty country. So could it be a BVI, a Cayman, Hong Kong. If a dividend was to come up to that individual shareholder in 2018 after the DRD system is in place, they would be taxed at 37% on the dividend income. Now, if we had that very same U.S. individual contribute the stock to a U.S. C corporation, so that now the C corporation owns the CFC. We have a dividend that comes up from that controlled foreign corporation. There's going to be the DRD, so it's not going to be taxed at the corporate level, and then it's going to come up from the U.S. entity to the U.S. shareholder as a qualified dividend rate, 23.8%. So that's a planning opportunity that that we've been thinking about at our firm with respect to the modified territorial So this is probably the least complex provision of the code. It is what it is. You get the 100%, and that's it. So the next slide. Everyone's favorite topic for those of you, like, again, who are involved with the involved a lot in international. You've heard of this mandatory repatriation tax, toll tax, transition tax, some other less nice names I've heard referred to over the course of the last couple of months. So what's really important, and I've spoken about this, we've had many panels at our firm, I've spoken about this many times before March 15th, returns were due, before extensions were due. And so hopefully now everybody is aware that things should have been done already last week, and I'm not telling you something that you don't already know. So this mandatory repatriation tax or toll tax is effective for the last tax year of a foreign corporation that ends before January 1st, 2018. So you have a calendar year taxpayer that has these controlled foreign corporations or specified foreign corporations as they're called. Under the code, you would have or potentially be subject to this transition tax. So what it looks at is you have your CFCs and they have positive earnings and profits that are just sitting there, have not been repatriated. What has happened here is the Treasury decided that perhaps in an effort to clean up foreign earnings and profits before we move to the DRD system whereby that income would not be taxed, well, with respect to a C corporation, they've decided that they are going to impose lower tax rates on this income, even though you're not pulling it back, and you're going to have to pay tax on it in the U.S. So what's important to know here is, unlike the modified territorial system, this mandatory repatriation tax applies to every shareholder of a specified foreign corporation. So you own at least 10% of the foreign corporation, you're an individual, you're an S-corp, you're a partnership, everyone was subject to this toll tax to the extent that you have foreign corporations that have positive earnings and profits. So there is a deferral for S-corporation shareholders. They must have joined the lobby with real estate and other groups that lobbied. I don't know where the shareholder lobby, the S-corp lobby came from, but for some reason they were able to get a deferral on this. So to the extent you're an S-corp and you own a foreign corporation, your S-corp shareholders get a deferral. And if you're going to be an S-corp, if you're going to be an S-corp shareholder for the duration of the business, if there's never a trigger event, if there's never a break of the S-corp of the S election, you're always going to it's going to be deferred indefinitely into the future. So again, we have no idea how or why that happened. As you know, S-corps and LLCs are taxed the same, so it's very strange. So a saving grace here, payment due over 8 years with no interest. So it's not an 8th every year. There's a specific payout plan, 8% for the first 5 years, then 15, 20, and 25 for the remaining years. Another important thing to note here is that there's different rates depending upon the cash and the non-cash assets of your foreign entities. To the extent that you have more cash and a non-capital intensive business, you're going to have a higher tax rate on the earnings and profits. And there are different rates for C corps and individual shareholders. C corps have a 15.5% rate on their cash and cash equivalent, and an 8% on the balance. And then individuals have a slightly higher rate, 17.54% for cash and 9.05% for non-cash. So here, if you were to read, this is 965 is the code. We sort of had to back into a lot of these numbers. So for example, for individuals, the IRS didn't say you use a 15.5% and 8% for everybody. If they had done that, that would have been great. We would have been fine with that. But they did it in terms of a rate differential calculation. So at the end of the day, I actually did algebra to which I can't even, I know, can't even believe I did the x over equals, I was like, I guess I remember that from grade school. So if you were to do the calculation in the way that the code intends you to do it, you end up having a denominator of 35%, which gets you to your 15.5 and your 8%, and 35%, as we know, was the corporate rate. If you make that denominator 39.6%, which was the max rate for individuals, you end up getting the 17.54% and 9. Yes.
Just a quick one, you talk
Yes.
about the sub-S deferral, so effectively you're sub-S corporation, you can bring back all the money and not pay tax on it as long as it's deferral, unless, until there's a treatment tax rate.
No, I know, you, well, as an S corp, you're still subject to, if you pull the money, cash repatriation is still gonna be a dividend. As an,
Okay.
yeah.
So that would be, so it's.
The repatriation tax has nothing to do with you bringing the money back. It's the money is sitting, which is what's irking everybody, because they're like, I'm not taking this money back when I'm paying this tax. So you're still paying the tax, even though you're not pulling the money back. As an S corp, you're not paying the mandatory repatriation tax. But to the extent you pull a dividend out, you're still gonna be subject to tax on a dividend.
Jennifer? So the concept of permanently reinvested earnings overseas of the C Corp is now.
So it's very important to note, this is a one-time event. This is the mandatory repatriation tax. It's a one-time event. It's a 2017 event if you're a calendar year. It's a 2018 if you are a fiscal year, which I'll quickly talk about. So again, people are like, I have to do this every year. No, this is a one-time mandatory repatriation tax. It's going to be, once you do it once, you're done. Your income becomes previously taxed income, and to the extent that you pull it out, that portion will be tax-free, which I'll quickly touch on also. Essentially this is, so Apple's a perfect example here. Apple had about $250 billion of cash overseas. They're paying it a $38 billion toll tax. They'll be paying it in 2018 because they're a fiscal year, and again, I think I should be getting to that very quickly. Very quickly now. So E&P measurement data, I just want to say, of course, the IRS couldn't come back and say, let's just look at the end of the year, let's look at 12/31. No, they couldn't do that. They gave us 2 dates, 11/2, 12/31, which day is your E&P higher. That's what we're going to use. But if you have a deficit, we're only going to use your 11/2 date. So to the extent you're an accrual basis taxpayer and you have accrued taxes, the IRS has graciously come out with some guidance 2 weeks ago on some of this stuff. 3 days before extension time, explaining some of this stuff for us. So again, you have these 2 dates. I have this toll tax template that my colleagues I know appreciate tremendously. I'm on version 11. I've never gotten a thank you. I just get, why are you sending these? But that's fine. I'm trying to help. Anyway, it did take me a number of days and again, a number of versions to get a template from my firm that that encompasses all of these very complicated calculations. And I've actually been offered from outside people some money to give it to them. So anyway, just some appreciation would have been nice, but that's fine. Exactly. Well, yeah, I'd have to talk to see if their CEO would allow me to get a cut of that. But so again, I just want to note that. For the impact really was for 2017 calendar year taxpayers to the extent that you have a fiscal year. Apple, for example, is a fiscal year. I believe they're a 9/30 year end, so they're going to pay the tax in 2019. So you do get this break if you're a fiscal year because it's for tax years that began before 2017, December 31st or January 1st, 2018. So you do get E&P deficits to the extent you have more than one entity. You have one that has deficits, one that has positive E&P. You can offset deficits against positive earnings and profits. There is a disallowance of foreign tax credits, this deemed paid credit concept that we talked about. There's a bit of a haircut there. You can elect to preserve NOLs also, as we know. If you have NOLs, generally you have to use them, carry them forward. There is an election that you're allowed to make where you can preserve your NOLs. So to the extent you have, for example, foreign tax credits that will offset the toll tax, why waste your NOLs? You can continue to carry them forward. There's some planning around, there's a concept of treating an individual as a corporation, getting some deemed paid credits coming through. Those are some planning opportunities we've been talking about at my firm. 2 very important points to mention. As I just mentioned before, the income inclusion, to the extent you pick this earnings and profits up under the mandatory repatriation tax, when you pull the money out in 2018, 2019, until you use up all that E&P, until you pull it all out, you are not taxed again. It becomes what we call PTI, or previously taxed income. So you can pull out a dividend, you'll pay this tax at a lower rate than you generally would. You'll pull out the money in subsequent years and not be taxed again. State tax ramifications. Where are you, Tom Walsh? Are you still here? Hi. Okay, so the states have given us barely anything, and anything that's come out has been within the last week or so. the real issue was, because we get this 8-year payout for federal, what are we doing for states? And the states have provided very, very limited guidance, and the guidance that we have that's sort of been trickling in lately is they're not allowing the 8-year payout. So our states are getting a tremendous windfall here. I have a client that's got a huge total tax liability, about $10 million. They're able to get an 8-year payout. He's paying about $800,000 in the first year, but he has to pay $6.8 million to New York City. So we were really getting a windfall here. They were jumping in crazy and trying to help everyone with property taxes and state and local taxes, but they were very quick to not allow this 8% and to take this windfall. So it's been hurting a lot of our clients. We did get a lot of recent guidance, like I said, literally days before extension time in terms of what you can apply and from 2017 estimated payments and how it's supposed to be reported and all of that. I've included a slide for that in there. And really, there's modifications to the anti-deferral regimes. There's something you may have heard of called GILTI, there's something you may have heard of called FEI, and there's something you may have heard of called BEAT. These are all wonderful acronyms of new tax legislation in the international tax context. And I have slides on them, and to the extent that you guys have any questions or want to talk about any of this, feel free. And wow.
Excellent.
This morning.
Thank you for the template.
Thank you, Joe. Head of our tax department, means a lot to me.
Are you able to provide us with this slide deck?
Sure,
and distribute to
absolutely.
everybody?
Yeah. Now, does anybody have any other questions? And then we ran over a little bit.
I have just one question, and I'm not exactly sure who it fits in properly to. It's a combination of GAAP/federal taxes. Obviously, after they passed the law, the deferred tax assets or liabilities had to get revalued, so on and so forth. Basically, by the time you filed your quarterly reports, or annual reports with the SEC. Now, the day after you file your fiscal year over, you have this new concept called revenue recognition. And it's going to put a lot of deferred assets and liabilities on the books of entities. The question is going to be, when you put that deferred liability or asset on your books, do you put the tax implications at the old rate, which is when the revenue was recognized, and then have to take a difference between, let's call it the 34-35% Fed to the 21% as a part of your current year provision? Or do you get to do that deferred calculation at the 21%?
And can I go over this?
I got the slide already up there.
Okay.
Look at that. Any questions?
Yes. Let me answer your question through this slide. I have 7 pages of slides. So what you have heard for the past 1 hour and 15 minutes, and that's a collection of major changes, not even everything. But when you have tax law changes, it has implication on your financial statements, especially your